Money FM 89.3, best of prime time. Market View on Money FM 89.3.
You're listening to Money FM 89.3. The start of the second half has been a fairly more benign one for greater Chinese markets. And despite a couple of hiccups here and there, it doesn't approach the downturn that we saw since the start of the year of the ox. Or of the new Lunar New Year. While things are fairly stable, there are still a few question marks, mainly coming from signs, at least, of the Chinese economic bounce back starting to cool off or perhaps peak just a little bit. Of course, COVID-19 concerns also continue to hit many markets across the Asia-Pacific region. And to talk about the outlook for markets, given all of these new complexities, we're joined once again today on Money FM 89.3 by Mr. Peter Chun, the founder of Silverbear Capital out in Hong Kong, to share with us his outlook on markets in Greater China and across the emerging market space as well, especially when you take into account all of these new developments. Peter, thank you so much for joining us today. Glad to hear you and your loved ones are still safe and in good health during these uncertain times. And welcome back to the show, sir. Good afternoon. I hope you're doing well.
Thank you very much. Love to be on.
All right, Peter. So listen, the big concern now for many markets, which really influenced a lot of the shakes and volatility in recent times, is COVID-19 cases back on the rise across the globe. Markets seem to be struggling for reasons to either move up or down. Some days, like say Monday, we saw investors spooked about the COVID-19 resurgence. Other days, like say today, we're seeing them shrug these worries off. Is rising volatility and a seeming lack of direction problematic for markets based on your experience investing and covering markets for the better part of the last couple of decades?
Well, I mean, definitely the volatility is being seen across the board. This I would say is kind of like a adjustment type of it's like a crossroad for a lot of people. So it's like, should we take the right or should we take the left? So I think there is no indicator that would allow the market to make a decision as of now. So that's why you're seeing a lot of volatility about people betting on one side and the other side as well. So COVID and all the other component would probably have to come in as well when people making a decision on things, because everybody is trying to speculate how the COVID is going to change the world and how the business are being done and who is going to be able to take advantage of the situation and who is being able to come up with a solution to manage the situation as well. So I think it's basically a crossroad at the moment. So let's see if other indicators will pop up as they come along, and then pinpoint the market to a direction.
All right. So, Peter, you also devote quite a bit of time actually looking at emerging markets, not just in Asia, but across the globe. Now, emerging markets and the respective economies have proven to be rather vulnerable to these rising COVID-19 infections. You can throw a stone anywhere in the emerging market space, and you're bound to hit an economy that's really been ravaged by the resurgence in infections. How is this impacting your outlook for the emerging market space? Are there any pockets of opportunities that might still be available, or do you think that emerging markets are going to have to be handled with caution, given a lot of the uncertainty that's really developed?
Well, there is some talks about the emerging market about to break out. So, but we've been paying attention to the emerging market quite a bit, and it's what we call the trading nations that we're paying attention to, especially. So these nations tend to give us surprises during these unique times, especially with COVID and the trade war between China and US as well. I would probably say we should continue to put faith into these emerging markets. I think the performances are being reasonable despite all the negative impacts around the economy as well due to COVID. So I would generally say the emerging market is still good to go based on our watch.
Mm-hmm. Any particular pockets of in the emerging markets that you think might be more lucrative than others, given your you're still slightly optimistic outlook, at least for emerging markets?
Yes, especially, for example, anything that's technology-wise within mobile attachment. So anything that have to do with your cell phone in the emerging market will be very good to look at. Medical, again, is something that we would propose to look at, because a lot of the emerging markets actually coming in to support the COVID solutions as well, but by providing, maybe producing masks at a lower cost. But while the cost is good, they're still FDA approved. So quality was not being defeated because of the cheaper cost. So these are the things that we are seeing that had still good momentum, put it that way, good momentum to what they're doing.
All right, we're speaking to Mr. Peter Chun, the founder of Silverbear Capital here on Money FM 89.3. Believe it or not, Peter, well, a lot of people, despite it being the second largest economy in the world, China is still considered a developing market. But for the most part, they've been fairly steady in the last 2 to 3 weeks, especially mainland Chinese equities. What's been propping sentiment up in mainland China based on what you're seeing? Is this the expectations of looser monetary policy, perhaps from the PBOC, or just the belief that China may be handling these COVID-19 outbreaks better than almost all nations in the world at the moment?
I think the COVID handling did add a plus to the scenario, correct? I would totally agree with that. But it doesn't mean that is the kind of the truth behind it. I think the policy handling did help a little bit. And the recent oil pricing coming back over $70 per barrel did help a little bit, because oil reserve is quite a huge amount with China right now. And I think everybody is kind of reading that the Chinese government had prepped up themselves for the ripple effect from the COVID as well. Not because they handled the COVID correctly, but they have prepared for the negative impact from the ripple effect from the COVID since last year. So they've been intervening different sector in China right now, industry-wise, to assist these industries to not fall apart because of COVID.
Mm-hmm. Peter, when we talk about companies in China that seem to be on the verge of collapsing or falling apart, there is the issues surrounding one of their largest developers, China Evergrande. We did hear today that 4 major banks in Hong Kong have decided to suspend offering mortgages for any of their upcoming projects in Hong Kong. And there are still some concerns as to whether or not they will meet some of these debt obligations, liquidity issues also hitting China Evergrande. Can you talk to us about what your outlook is for China Evergrande? And more specifically, if the worst does happen, what kind of fallout for broader markets in mainland China and Hong Kong could a collapse of China Evergrande have across the markets?
Well, I think everybody is kind of reading the Evergrande outlook with a mindset saying they're in trouble. Mm-hmm. Yes, financially, I don't think anybody will have a dispute on that. But I think the bank stopping their acceleration of the projects in Hong Kong is a good start, because I think Evergrande, if they work correctly with the regulators or other government agencies which they're closely attached to, after all, they are a very big corporate in China. To kind of stop a little bit, stop the acceleration. Take a look what's going on, restructure themselves a little bit, and started to kind of untie all the other problems that they have before they moved ahead. So this is actually a good news to their shareholder. If anybody is their investors, and it's good news for China economy as a whole, because something like Evergrande of this size and shape and form would probably affect all the other players similarly in China with regards to bank lending as well. So it's important that Evergrande would liaise with advisors around them to say, okay, well, yeah, I will stop moving forward. I would not borrow more. I would take a look what's going on first. I would restructure, and then after that, then we will move forward again. So I think this is actually good news.
Mm-hmm. But is Evergrande perhaps too big to fail? Now, we've seen China not shy away from perhaps taking some of their biggest corporations to task But is Evergrande perhaps too big to fail? And I guess it goes back to my question as to what's the worst that can happen should Evergrande and heaven forbid they actually fold. If the worst happens and Evergrande does fall apart, how bad could the fallout be for markets?
Well, I mean, if Evergrande does failed, then obviously, you'll go into bankruptcy, or some white knight will come over and take over and restructure the loan. That's kind of the normal landscapes that we see. Somebody would just come popped up, from the open and say, okay, well, I'll be the white knight and restructure this, or maybe China Evergrande will be able to successfully restructure. That's another option. But if all things fail, obviously this would create a domino effect around the banking system as well, because all the banks are then being in need to review the portfolio correctly and put adequate reserve to back up their mortgage loan, because this incident suddenly happened, which they were not expected during their relationship with Evergrande. So then again, this domino effect will then, of course, slow down the whole real estate development sectors, because bank is lending slowly rather than normally. And then this will just go back and into the ecosystem, slowing everything down, because real estate is a major component in the economy. So